Most people discover dividend investing the same way. They see a video online. Someone is showing a portfolio that generates hundreds or even thousands of dollars every month. The message sounds almost too good to be true. Buy a few stocks, collect passive income, retire early. Simple. And that's exactly why millions of people become interested in dividend investing every year. But there's one problem. Almost nobody talks about the math. Because while dividend investing can absolutely be a powerful wealth-building strategy, most beginners focus on the wrong thing. They focus on the income, when they should be focusing on ownership. And that distinction changes everything. Today, we're going to investigate whether you can really start dividend investing with just $100. We'll cover how dividend investing works, the biggest mistakes beginners make, the danger of dividend traps, how to identify quality dividend investments, and the exact framework smart investors use to build long-term income-producing portfolios. So, let's begin. Before you can build a dividend portfolio, you need to understand what a dividend actually is. A dividend is a payment made by a company to its shareholders. Think of it this way. When you buy stock, you're not buying a lottery ticket. You're buying ownership in a real business. And if that business becomes profitable, the profits don't just disappear. Management has several choices for how those profits can be used. They can reinvest the money into the company. They can acquire another business. They can buy back shares, or they can distribute part of those profits to shareholders. That's a dividend. In simple terms, the company is sharing some of its profits with its owners, and as a shareholder, you're one of those owners. This is what makes dividend investing different from many other investing strategies. Instead of relying entirely on stock price appreciation, investors may also receive cash distributions while continuing to own the asset. But this leads to a common misunderstanding. Many beginners assume dividends are free money. They're not. Dividends come directly from the profits generated by the underlying business. You're getting paid because you own a piece of the company, not because money magically appeared. Understanding that concept is critical, because successful dividend investors don't think like consumers. They think like owners. Now here's where things get interesting. Most beginners focus on one number, and that's dividend income. They want to know how much cash they'll receive, how much passive income they'll earn, how quickly they can replace their paycheck. But experienced investors focus on something completely different, and that's ownership. Let's imagine two investors. Investor A receives a dividend payment and spends it. Investor B receives the exact same dividend payment and reinvests it. At first, the difference seems small, but over time, Investor B accumulates more shares. Those additional shares generate additional dividends, which purchase additional shares, which generate even more dividends. And suddenly, something powerful happens. The portfolio starts growing itself. This is one of the most important ideas in dividend investing. In the beginning, your goal shouldn't be maximizing income. It should be maximizing ownership, because ownership is what creates future income. One of the biggest myths in investing is that you need a lot of money to get started. Years ago, that was partially true. Many stocks traded at prices that were difficult for small investors to afford. If a single share cost several $100s, your options were limited. Today things are very different. Modern brokerages allow investors to purchase fractional shares. Instead of buying an entire share, you can buy a fraction of one. That means your $100 can immediately be invested across quality businesses or diversified funds. The barrier that once prevented small investors from participating has largely disappeared. And that's a huge advantage, because the most valuable asset in investing isn't money, it's time. A person who starts investing early with $100 often has an advantage over someone who waits years trying to save a larger amount. The earlier compounding begins, the more powerful it becomes. Now let's talk about one of the most dangerous mistakes in dividend investing: the dividend trap. Many beginners search for the highest dividend yields they can find. They see a stock paying 10%, 15%, 20%, sometimes even more, and immediately they assume higher yield means higher returns. But that's often exactly what gets investors into trouble, because a high dividend yield can sometimes be a warning sign. A company may be struggling financially. Its stock price may be falling, its profits may be shrinking, and eventually management may be forced to reduce or eliminate the dividend entirely. The yield looks attractive, but the business underneath may actually be falling apart. That's why successful dividend investors don't just ask, "How much does this stock pay?" They ask, "Can this company continue paying and growing its dividend 5 years from now?" That's a much more important question. At this point, every beginner faces a decision. Should you buy individual dividend stocks, or should you buy a dividend ETF? An individual stock gives you ownership in one company. If that company performs well, you benefit. But if that company struggles, your investment suffers. A dividend ETF works differently. Instead of owning one business, you own a collection of businesses. That means your risk is spread across multiple companies. One company has problems, the entire portfolio isn't destroyed. This is called diversification. And for many beginners, diversification is one of the most valuable tools available. Because investing isn't just about making money, it's also about managing risk. Now that we've talked about dividend stocks and ETFs, there's another important question. How do you know if a dividend investment is actually good? Many beginners look at one number: dividend yield. And while dividend yield matters, it doesn't tell the whole story. A high yield may look attractive, but as we discussed in the previous chapter, some high yields are actually warning signs. That's why experienced investors look beyond the yield. They focus on the quality of the business. The first thing they look for is profitability. Is the company consistently making money? Because a company that isn't generating profits will eventually struggle to maintain its dividend. The second thing they look for is dividend history. Has the company maintained its dividend through difficult periods? Better yet, has it consistently increased its dividend over time? The third thing they look for is future potential. Can the company continue growing earnings in the years ahead? Because a dividend is only as reliable as the business paying it. The strongest dividend portfolios aren't built by chasing the highest yields. They're built by owning high-quality businesses that can continue rewarding shareholders for years to come. This is where dividend investing becomes truly powerful. Imagine receiving your first dividend payment. Most people see income, but experienced investors see something completely different. They see fuel. Instead of spending the money, they reinvest it. That dividend purchases additional shares. Those shares generate future dividends, which purchase even more shares, and the cycle repeats, year after year, decade after decade. At first, the growth appears small, then it becomes noticeable, then it becomes significant. This is the compounding machine, and it's one of the most powerful forces in investing, not because it works quickly, but because it works consistently. At this point, the process becomes surprisingly simple. Step 1. Open a brokerage account that allows you to purchase fractional shares. Step 2. Fund the account with your first $100. Step 3. Choose a diversified dividend strategy. For many beginners, that may mean a dividend-focused ETF. Others may prefer a small collection of individual dividend stocks. Step 4. Make your first investment. Step 5. Whenever possible, reinvest your dividends. And Step 6. Stay consistent. Because $100 invested once probably won't change your life. But $100 invested consistently over many years can produce very different results. Successful investors don't rely on motivation. Motivation comes and goes. They rely on systems, because systems keep working long after motivation disappears. So can you start dividend investing with just $100? Absolutely. But here's the truth most people miss. The goal isn't collecting dividends. The goal is building assets. Dividends are simply evidence that those assets are producing cash flow. Imagine owning a portfolio that sends you cash every quarter. Not because you're working overtime, not because you started a second job, but because you own businesses that continue generating profits whether you're awake or asleep. Your first $100 probably won't generate life-changing income. Neither will your second or your third. But the habit of consistently buying income-producing assets can completely change your financial future. Because wealth isn't built by spending. It's built through ownership. Every successful dividend investor started somewhere. Not with $1 million portfolio, not with perfect timing, not with secret knowledge, just with a decision. A decision to stop watching from the sidelines and start building ownership one investment at a time. The question isn't whether $100 is enough. The question is whether you're willing to begin or not. If you found value in this video, hit the like button and subscribe to the Wealth IQ for more evidence-based investing insights. And let me know in the comments, what's the first dividend stock or ETF you're thinking about buying with your first $100? Thanks for watching, and I'll see you in the next one.